So what if you could turn your mortgage into a powerful wealth building tool? If it sounds too good to be true, then make sure you stick around because today we're diving deep into one of the best kept Australian tax strategies known as debt recycling. If you've been wondering how you can reduce your mortgage, pay less taxes, but also grow your wealth all at the same time, then debt recycling could be the game changer that you've been looking for. Whether you're looking to invest into shares or property, debt recycling is a tax strategy that you need to know about. By the end of this video, you understand the differences between good versus bad debt, how debt recycling can work for you, and most importantly, what the exit strategy is with debt recycling, which is often a topic that I don't hear a lot of creators talking about on YouTube, so make sure you stick around till the end to learn about that. All right, so let's break down the difference between good debt versus bad debt, because this is crucial to understanding debt recycling. So what exactly do I mean by good debt versus bad debt? Good debt is used to acquire income producing assets. That could be an investment property or shares. Essentially, it's an asset that generates you cash flow. Bad debt is typically associated with your primary property of residence. This is because it isn't generating you any income and the tax is also not tax deductible. Now, some of you might argue that your home is actually an asset because the value of your property can increase over time, which is definitely true. If you decided to sell your house after 10 years of living in it, then it's highly likely that you've made some capital gains over that period of time. But whilst you're technically not wrong, in my opinion, the home that you're living in is actually a liability. Why, you might ask? Well, because it takes money out of your pocket every single month. Because you need to pay for your mortgage repayments, you need to pay for council rates, insurance, maintenance, etc. All at the same time that no income is being generated. Unless you use the equity in your property to purchase income generating assets like another investment property or shares. That's when your home transforms from a liability to an asset. And this is where debt recycling comes into the picture. So what is debt recycling, you might ask? Debt recycling is all about transforming your bad debt that is non-tax deductible into good debt that is tax deductible. The goal here is to use this strategy to pay down your home loan whilst also investing into income generating assets. It's a pretty simple concept, but the benefits can be massive if done correctly. According to the ATO website, if you borrow money to buy shares or related investments from which you earn dividends or other accessible income, you can claim a deduction for the interest that you have to pay. To put it simply, with debt recycling, what you essentially do is you take cash that's maybe sitting in your offset account or available equity and use that to pay down your home loan. Then you borrow that same amount of money in a separate loan and then use that to invest into an income generating asset. And now the interest that you have to pay on the money that you've just borrowed to invest into an income generating asset is now tax deductible. So who should be using debt recycling? Well, debt recycling only works if you can meet two key criteria. Firstly, you have to have a mortgage, and ideally you've been actively paying it down over a period of time. And secondly, you have cash or available equity that you can use to invest into income generating assets like property or shares. If you can tick both of these boxes, then debt recycling can be a very smart strategy for your financial future. If not, it might be worthwhile keeping this strategy in your back pocket for when the time is right. Okay, so next let's dive into the mechanics of how you would actually set this all up. The simplest way to start debt recycling is by using cash that you already have. Let's say you have a $600,000 mortgage and you've got $100,000 either sitting in a high interest savings account or in the offset account. Here's how you can start debt recycling. Firstly, you would take your $600,000 mortgage and you would split that into two loans. The first one would be for $500,000 And then the second loan would be for $100,000. You would then use the $100,000 in cash that you have sitting in your offset or a high interest savings account and then pay down the $100,000 loan. Now you might need to only pay it down to $100 or something small, but make sure to check with your bank that they aren't going to close the loan down when you pay it down. After you've paid down the debt, you can now redraw that $100,000 and put that money into your brokerage account. You would essentially then use that $100,000 and then invest it into a diversified share portfolio or another income producing asset. And now the interest that you have to pay on the $100,000 loan is now tax deductible because it's been used to invest into an income generating asset. So assuming that $100,000 loan had a 6% interest rate, this means that you'd be paying $6,000 in interest on that loan each year. And if you're earning $100,000, this means in the eyes of the ATO, your taxable income has now reduced to just $94,000. Now, for any dividends that you receive from your share portfolio, you would actually use that to make extra repayments towards your non-tax deductible or bad debt. So assuming a 4% dividend yield on a $100,000 share portfolio, that's $4,000 of additional income that you can now divert towards paying down that bad debt. Now that $4,000 of dividend income will be added back to your taxable income, so we do need to take that into account. But the net benefit that you receive is still greater compared to if you didn't debt recycle. Now, once you've paid down your non-taxable debt down enough, you can actually repeat this process over and over again by splitting out the loan, paying it all down, and then redrawing it to invest into income generating asset. And if you do this long enough, you can actually convert the full $600,000 of bad debt into $600,000 of good debt. Now, obviously, based on your own risk tolerance, you could choose to debt recycle the full $600,000 or just do a portion of that. It's really all up to you, but obviously the benefits are going to be greater the more you debt recycle. But even at $100,000 or $200,000, the benefits are still really good. Now, a common question that people have about debt recycling, and one that I had before I started doing my research into this, is what happens at the end. Let's say you've now taken $600,000 worth of bad debt and converted that into $600,000 worth of good debt. Your net debt position hasn't actually changed over the years, but now you're getting all of these tax benefits from that good debt, and you're also getting a constant stream of dividend income as well as the capital growth that you'd receive from the shares. But you still have $600,000 worth of debt that you have to pay back to the bank. So what do you do now? Well, there's a few possible solutions. You can actually begin paying back more than the minimum and begin paying down your debts. In this case, you could also change the loan from being interest only to being principal plus interest, so you pay down the loan quicker. You can also just decide to use an offset and just have the cash sit there, and instead of making extra repayments into the loan, use the extra money to invest into more shares. Or simply continue paying the minimum and using any additional cash to invest outside of this structure. There's no wrong or right answer, and it's all related to your own personal risk tolerance. The assumption is that the long-term returns of the share market will exceed the long-term interest rates, meaning that you'd actually hold for as long as possible within your loan term. Some people may decide to get some initial exposure to debt recycle and only recycle $100,000 or $200,000 worth of debt. Then they would focus on actually paying down their non-tax deductible debt before focusing on paying down their tax deductible debt. But I do think it's a good idea for the majority of people to be aiming to be debt-free, regardless of whether or not it's good debt or bad debt, prior to being retired or at least shortly after retirement. To wrap it all up, debt recycling is an excellent tax strategy for those who have a mortgage plus some additional cash or equity that they could use to invest into income generating assets. It's a way to pay down your mortgage faster, save on taxes, whilst also building wealth all at the same time. Now, obviously it's not without its complexities. The example that I obviously walked you through is a much more simplified approach, but with the right planning, it can be a no-brainer. If you think debt recycling could be right for you, definitely do more research. Speak to a mortgage broker, accountant, or financial advisor who specializes within this space. If you found value in this video, make sure to hit that like button down below and subscribe for more personal finance content in the future. Comment down below with any questions that you have. And if you want to learn about strategies that would help you shave 7 to 10 years off paying down your mortgage, then check out this video right here.